Mark, it is really good to see you. Today, we are sharing 3 year-end tax tips. The end of the year is always a great time to start thinking about your taxes for the upcoming year. So we are sharing 3 tax-saving tips that you can do now to help you get on track for 2024 and perhaps the rest of your retirement. And first, you say people should consider maxing out their Roth IRA or consider a conversion. Some are even calling October Rothtober.
Yeah, good to see you, Aaron, and thank you so much for having me on again. Yeah, I mean, this is the month we call Rothtober. Now, the reason we're mentioning a Roth versus contributing to a tax-deferred IRA and getting the deduction is really our belief is tax rates are going to go up. And in fact, Congress can do nothing and tax rates are going to go up in 2026. So if we can build more tax-free income down the road, then if tax rates go up and we're in a zero tax bracket, 0 times 0 is 0. So what we're recommending is, people look at Roth conversions and Roth contributions. Now, if you can't qualify to do a Roth contribution, then there's this other idea that's still available. It's called the backdoor Roth IRA. And that's simply where you make a contribution to a traditional IRA, and then you convert it to a Roth IRA. And Congress may take that away at some point, but there is an opportunity for those high income earners to still contribute to Roth IRAs this year.
Mm-hmm. And next, you say offset your gains by harvesting losses. This is known as tax loss harvesting.
Yeah, so a lot of people with brokerage accounts, and of course, brokerage accounts you get taxed on every year. And a lot of people don't, they might own Apple or Nvidia at big gains or something, and they don't want to sell that. But then if you really start looking at your portfolio, this is why we call it harvesting, because what we want to do is we want to kind of go, well, we've got some losers here, or some companies or mutual funds that are underperforming and they're at a loss. Well, obviously, we can't deduct the loss other than $3,000 a year. But I've seen tax returns where people have $30,000 of capital losses and they have to continually pay it forward. So what we can do is we can sell some of those winners, trim those positions to offset the gains, offset the losses that we have when we capitalize those losses. So then we can remove that from our tax return, and essentially there is no tax. So we can take the gains, no capital gains tax, and offset the losses that we have.
Yeah, interesting. That's a great strategy. And third, you say seek tax efficient investments. What does that mean specifically?
So when we're talking about tax efficient investments, and this is particularly in the taxable bucket, I mean, ideally, what we would want to do with people, if we believe that tax rates are going to go up, and the math is suggesting that tax rates are probably going to double at some point, or at least go up significantly. We really want to get either more tax efficient in the brokerage accounts or reduce the exposure there and move that to the tax-free bucket. So really, but if we have, let's say, 6 months of income in our taxable bucket, which is what is recommended, we really need to have something that doesn't create a lot of dividends and taxable interest, or, we don't want to do a lot of short-term trading where we've got short-term capital gains and those sorts of things.
Mm-hmm. And you wanted to mention 2 strategies specifically, starting with what's known as the QCD.
Yeah, so the qualified charitable distribution is a unique strategy. Of course, you have to be past your required beginning date, meaning you're now taking required minimum distributions. So if you're already taking these and you want to be charitable continuing through your retirement, this is where we can take that money out, pay no taxes on it, and then essentially we're gifting it to the charity of our choice.
Such a win-win. And then the third is for anybody who's part of a high deductible health plan, an HSA.
Yeah, so we love HSAs. I mean, because again, the contributions are tax deductible. We can invest the money, so we've got some control on how we manage that. And then when we take it out, all the growth is tax-free as long as we use it for what we call qualified withdrawals for, specific health reasons.
Yeah, that's great, especially considering most everybody's greatest expense in retirement is your healthcare. These strategies are really interesting, Mark, some of them a little bit more advanced than others. If somebody has questions about trying to implement them, what's the best way to reach you?
Well, they can reach out to us on the phone call. Anyone from our team will definitely help answer some questions. We can schedule an appointment. Our phone number is 303-681-0113. You can also go to our website. We do have a link where you can schedule an appointment, and that is mcgregorwealth.com.
All right. Mark, thank you.
All right. Thank you, Aaron. I appreciate it.